Hello there, and welcome to iSectors' third quarter 2024 market review video. My name is John Koch, iSectors Senior Investment Analyst, and I'm joined by the CEO and CIO of iSectors, Vern Sumnicht. Vern, you want to get us started today?
Sure, thanks, John. This quarter, John and his team have done some interesting work on market breadth, which we think is important to note. And we also want to note that market breadth is not everything, but it is a factor, and we think it's an important factor. We also want to note that our opinions really haven't changed. We still believe that we are in effect in a stagflationary environment, and that we don't want to overemphasize some of these things, but we do think the market is looking good based on the breadth of the market. And John's got some great research on this that he wants to present, and I'll just give it to John.
Yeah, thanks, Vern. So, as you mentioned, the breadth of the market seems to be improving. The third quarter was very different from the first and second quarters of this year. Mega cap technology stocks were not the best performers like they had been throughout most of the year. Mid and small cap stocks outperformed large cap stocks, and every single sector except for communication and energy outperformed technology in Q3, with real estate and utilities being the best performers of the GIC sectors. Now, usually something like that only happens when the market is down in a quarter, like back in 2022, but the S&P 500 was actually up this quarter by about 5.9%. In fact, this was the best quarter since 2022 that the equal weight version of the S&P 500 had versus the market cap weighted version of the S&P 500. We like to look at the equal weight S&P 500 as a sort of barometer for market breadth because it isn't so heavily weighted in the top 10 names like the regular S&P 500 is. You can see that in the chart on the right. The top 10 names in the SPDR S&P 500 ETF SPY occupy about 35% of the index, while those same 10 names only occupy about 2% of the equal weight index, represented here by the Invesco ETF RSP. Now, historically, RSP outperforming SPY is not something that would only happen in one or two quarters every few years. It was a much more normal occurrence. In fact, if you looked over the last 20 years, equal weight has outperformed SPY most of the time, as you can see on the chart. The blue line is RSP, the green line is the S&P 500. When the equal weight outperforms the market cap weighted S&P 500, investors generally have more confidence in the broader economic environment and the stock market as a whole. And when most of the stock market's growth is concentrated in just a few large stocks like it had been the last few years, investors tend to have less confidence in the strength of the overall economy and stocks in general. So speaking of the overall economy, as Vern mentioned earlier, we do have thoughts there. The current economic environment, it's interesting. You can see on the chart that this shows the year-over-year change in CPI. Inflation is moving closer to the Fed's 2% goal over the last year, but we don't think we're quite out of the woods yet on inflation, especially given that the interest rate cutting cycle has only just begun last month in September. Even before the Fed reduced interest rates last month, the growth of money supply had been increasing steadily since last September 2023, as you can see on the chart here, represented by M2 money supply, the year-over-year change almost increasing every single month since last September. And if there are more cuts before the end of this year, the money supply is only going to continue to increase and most likely at a faster pace. And so this is concerning because over the last 10 years, the injection of liquidity when money supply increases, it's almost always led to increased inflation in the following 18 months using an 18-month lag. So the chart here shows the two numbers I showed earlier, the year-over-year CPI change lagged by 18 months over the year-over-year change in money supply. You can see they follow a very similar pattern. Essentially what it means is that when the money supply increases, this tends to lead to an increase in the CPI in the following 18 months later. In fact, when you chart these numbers lagged by that 18 months, their correlation is over 80%. Now, we don't think this guarantees another surge in inflation, but if the Fed cuts rates too much, too quickly before the end of the year, there certainly is a chance of that happening. And it'd be good for investors to be aware of that. The good news is that iSectors has a model for almost any market environment, and we do offer some models that have performed very well recently and also help protect the downside in 2022 when inflation was plaguing the stock market. The iSectors inflation protection and precious metals allocations come to mind, along with the dynamic iSectors post-NPT allocations that currently have a healthy weighting to gold as a hedge for many different scenarios, including inflation, but also geopolitical and recession risk as well. If you'd like more information on any of those models or want to hear more of our thoughts on the stock market and the economy overall, give us a call. Have a great day.